Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 244 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good afternoon, Matt.
Good afternoon, Mark. How is the quarter finishing up so far for you?
Really nice, actually. I was actually going to bring this up a little bit later, but we can talk about it now. It might not have been that long ago, at least it feels like it, Matt, where the start of a year has actually been kind of mellow, kind of nice for investors and
How long has
people
it been
in
since that
the
happened?
markets. And it might only be a couple of years, but man, it feels like a long time. So it's actually been kind of nice, low volatility. Not much in major news around the world that are affecting markets. So it's been a pretty smooth start for 2024, I would say.
Feels like a rarity, and I will accept it and fully embrace it.
Yeah, we'll take these starts to the year while we can get it. So just about another week before the end of the first quarter. I know it's hard to believe. It seems like time just keeps going quicker and quicker every year that passes, but going to be the end of Q1, and in a couple weeks time, a little over a month, we're going to be right back into earnings season. So
Yeah, you're right.
Which it feels like we just
Finished it up.
But anyways, in the spirit of March Madness, I don't think it'd be proper to continue without talking about our Dayton Flyers really quick. Yesterday pulled up a huge comeback win against Nevada. I think they were down like 17 points in the second half or something like that, and they came back and won the game. So what are your thoughts?
Biggest comeback in 5 years in NCAA March Madness history, best in 5 years. You just don't know what version of the team you're going to get, not only game to game, but what time of the game. They obviously show that they have not only the athletic ability to perform. They could beat anybody on any given day. It's just you just don't know when lightning's going to strike.
Yeah, it was interesting because I was watching the game yesterday with Kenzie and Mia, and they were down, 12 or 13 points with like 6 minutes left or something like that. And it was Mia's bath time. So we, went to give Mia a bath, and we came back out to the living room, and I was about to go change her, and, she was going to eat and go to bed. And then there was 15 seconds left, and Dayton was up by 1. And I was like, whoa, what?
What happened here?
What happened? So, yeah, very pleasantly surprised. So they have Arizona tomorrow at 12:45. So that's going to be a tough task, I think. But like you said, they could beat anybody if they're shooting well. So if Brea keeps pulling up and hitting those threes, and Duran Holmes does some work down below,
yep,
anything can happen. It's why they call it March Madness, right?
That's right. That's right. You hit Kentucky. That was beat yesterday. That was a big upset. So there's anything can happen.
Yeah, so going to be interesting. So hopefully they can keep this train rolling. But anyways, back to our normal schedule of events. We will quickly review the month to date and year to date performance of the major market indices that we track, and this data is from YCharts and as of the market close on March 21st. S&P 500 index up 2.9% for the month and up 9.9% for the year. Dow Jones Industrial Average up 2% for the month and up 5.5% for the year. NASDAQ Composite Index up 1.9% for the month and up 9.3% for the year. The small cap Russell 2000 Index up 2.1% for the month and 3.6% for the year. And the Vanguard All World ex United States ETF up 2.9% for the month and 4.4% for the year. 3-month Treasury rate at 5.48%, the 2-year Treasury rate at 4.62%, and the 10-year Treasury rate sitting at 4.27%. Really, the only big headline current event that I can think of this week worth noting, Matt, is obviously the Fed held their March meeting on Wednesday. As expected, they held rates steady, and they noted that they expect around 3 rate cuts for the rest of 2024. So obviously, before 2024 got started, the futures were pricing in the first rate cut here in March, but that obviously has been pushed back a little bit this year.
Yeah, I mean, I think as per my podcast comments a couple of weeks ago, if you look at the data, the longer they hold rates and the slower they are to cut, historically, that is good for risk assets such as stocks. So if you are an equity investor and you hear this news, you want to welcome that if you look at history.
Yeah, for sure. Again, something that we haven't seen in a long time. It felt like the Fed was taking action, every other month there for a little bit, but nice to get some tranquility, as I'd like to say, on the Fed interest rate cycle.
And I'll note the market rallied after the announcement for the record, which is not a common thing under Jay Powell.
Right.
So from 2 to 4, the day it was announced, the market did rally into the end of the day.
Yeah, which was great. That was great. So, anyways, moving on to tweets, articles, and research from this week. First thing I had, Matt, was a tweet from Charlie Bilello on March 13th. And people that are watching this on YouTube, you'll be able to see this on the screen. It'll also be in our show notes. But Charlie said that over the last 30 years, the purchasing power of the U.S. consumer dollar has been cut in half due to inflation. At the same time, the S&P 500 has gained 840%, or 7.8% per year, after adjusting for inflation. Why you need to invest in one chart. So, don't really think there's much more needed to be said, Matt. This is the reason why we invest in the first place, is to protect our purchasing power. And I know, for people that are just getting started and understanding markets and the economy, and inflation for that matter, is, typically in general, prices go up over time, right? So the price of eggs today is not what it was 30 years ago. And if you as a consumer has an income that stays flat over a 20-year period, you're actually going to be taking home less money because things cost more, right? And this is the essence of why we invest in the first place, like Charlie said. So this is good to keep in mind when sometimes people can attribute the market feeling like it's gambling, or they don't understand it. Why do I need to invest? It's kind of just risking your money. I think this is a pretty good reason provided by Charlie here in this chart.
Yeah, I mean, we started the podcast before the inflation really hit the economy, and well before inflation was a hot talking point. We would talk about it on this podcast, and we would reference it as the silent killer. And you've really seen as the inflationary environment got out of control a couple of years ago, you might have got that bank statement, a year later showing that, you still had 100 grand in the account, but the purchasing power was 90 cents on the dollar. They're not going to show you that on the statement. And so I just think that you have a proper time horizon. It's a good emphasis as to why someone's net worth needs to be in producing and performing assets. Otherwise, you're going to have a decay in your purchasing power. That's it at the end of the day.
Yeah, precisely. Next thing I had, Matt, was a tweet from Ben Carlson on March 11th. And it was in regards to stock market concentration. So Ben says stock market concentration is nothing new. And this chart that you're going to see is a graphic of the industry weightings in the US and in the United Kingdom in 1900 and in 2024.
Oh, this
So
is awesome, Mark.
as you'll see, Matt, the rail industry was a massive portion of the economy and the stock market in general, both in the US and the UK back in the early 1900s. And for example, in the US, rail was over 50% weighting. So when people say today, oh my gosh, technology is way too large of a position in the S&P 500, for example, this has never happened before. Well, that's not really true. It's been a while since there's been one industry that's made up a really large portion of markets, but in this graphic, it looks like rail was 60% or maybe even higher than 60% of the total stock market. So this really isn't anything new. We've seen this before. And guess what? In another 30, 40, 50 years from now, this is probably going to look completely different, right?
Yep. Yep. We've talked about that in the podcast in the past too.
Markets do a really good job, in my opinion, in overweighting outperforming sectors or outperforming industries or outperforming companies, right? The biggest companies the biggest companies in the world are the biggest companies in the world for a reason, right?
Mhm.
Top performing, produce the best product, produce the best services. You can go on and on. But that's just kind of how markets work. So it's going to be interesting to see if this evolves and changes over the next decade. And my guess would be that it will.
That's right.
But this really is nothing new. So I don't really think it's a major concern of ours, or should be a major concern of investors, that technology is, whatever it is, 24, 27% of markets.
My only comment is this is not a prediction. This is just a chance that this could occur. We could get 15, 20 years down the road and the weight in technology could look like rail in 1900, Mark.
Right.
It's a possibility of occurring, and you can just see the evolution of technology, the pace of innovation, the utilization of tech, so on and so forth. It's not out of the realm of possibilities that we get 15, 20 years down the road and tech makes up 2/3 of the index. It's a possibility.
Yeah. It doesn't mean tech needs to shrink. It could keep growing bigger and bigger, and I actually wouldn't surprise me if that were to happen. So,
Yep, just something to
yeah,
throw out there.
yeah, for sure. Last thing I had, Matt, was something from a newsletter from Taylor Schulte at Define Financial, and he kind of discussed 3 investing lessons from Warren Buffett that I thought were pretty interesting. He says, lesson number 1: ignore all market forecasts. He doesn't say we should sometimes ignore the pundits, but they should always be ignored. So again, just a lot of noise out there. Just because one expert or analyst says something doesn't mean it's going to be true. Just because some hedge fund manager has 50% of his clients' money in one stock doesn't mean you should be. So ignoring
Right.
all market forecasts is probably a pretty good starting point for new investors.
Yeah, this might go down a quick rabbit hole, but when you hear like these hedge fund managers having 2 or 3 positions, we got to remember that they have different time horizons, different risk tolerances, different appetite for volatility. And just because XYZ person got it right in 2008 doesn't mean that they're going to get the next bull prediction right.
Correct. Kind of flows nicely into lesson number 2 from old Warren, Matt, is be permanent and patient owners of stocks. He says, I can't remember a period since March 11th, 1942, the date of my first stock purchase, that I have not had a majority of my net worth in equities or US based equities. And so far, so good. America has been a terrific country for investors. All they need to do is sit quietly, listening to no one.
Well said.
And last but not least, number 3, if you are prepared, there's no reason to predict. During the 2008 panic, Berkshire generated cash from operations and did not rely in any manner on commercial paper, bank lines, or debt markets. We did not predict the time of an economic paralysis, but we were always prepared for one. And, kind of transitioning this to the everyday investor, or, to financial planning for Americans, I think the best way to correlate this is why you have an emergency savings fund, right? So you have 3 to 6 months of living expenses, so that, when tough times do come, that you don't need to go and take a personal loan or go and take a 401k loan, because we've talked about that on the show before, how detrimental that could be to your ending net worth or the total value of your accounts by the time you retire. So you just always need to be prepared, and that's why you put a plan in place, right? So thought this was pretty good points that Taylor picked out from Warren Buffett, obviously one of the most famous investors in the history of the planet. So what are your thoughts on this?
No, I think they're spot on. I think that a lot of times we have to acknowledge and accept that risk assets carry periods of short-term downside volatility, right? And what you are going over is going to blend very well with a couple of things I prepared for investors because right now we're in one of those periods of low volatility. Things seem easier than they normally are. And when people let their guards down, we get any sort of volatility, it's going to feel magnified in this environment. Well, guess what, listeners and viewers? You are going to be rewarded over the next roughly 5-10 minutes. And I'm going to give you a lot of data to get you prepared for what could be coming later this year.
Okay, let's just dive right into it.
All right, so here it is. My first piece is an ex-post by Bob Elliott. He's the CIO of Unlimited Funds on March 10th. Let me share my screen, and after I do this, Mark, I'm going to give you my thoughts on this piece. What you're going to see, can you see my screen okay, Mark?
Yeah.
So what this is this is a chart showing previous beginnings of a bull market dating back to 1957. The source of the data is Bloomberg, is where he got it. What you're going to see in the mustard colored line is the median bull market, and in the black is going to show the current bull market that began in October of 2022. And then what you're going to see there kind of in that turquoise is the range of bull markets dating back to 57. So why am I highlighting this, Mr. McEvily? The current market narrative is that the market has come too far too fast. Could the market be due for some sort of short-term sell-off, breather, rest, consolidation? Call it what you will. Of course. But don't come at me and say the market recovery off the bottom is unprecedented compared to history, because guess what, folks? It's not. Your comments.
Yeah, I don't think I really have anything to add. It's definitely an interesting chart that not one of our normal things that we go over, but we've talked about a lot of things too that over the past couple of months that aid to maybe the fact that this current rally is just kind of getting started. And I know that that might upset some people. It just seems like today that there's so many more people out there that get so angry when stocks go higher. And I don't know if that's just because they like to play that character or if they were invested in cash and bonds and missed the move to the upside. I don't know what it is. It's definitely exacerbated by social media, I think, these days. But yeah, this is a rally that everyone seems to hate.
It was interesting you say it that way because I was in a face-to-face client review meeting this past Tuesday with one of our Jessup Wealth Management clients in Columbus. And this client, we were talking about the state of the American consumer. And the client stopped as I was talking and he goes, Matt, you have to understand that a majority of Americans are just perpetually unhappy. And he goes, it's just interesting because as you spoke, what I heard you say, and this is the client speaking to me, Mark, he said, I hear you saying on paper, the consumer looks good. But when they fill out any sort of sentiment surveys or what they're saying is horrible, and that matches up with what I hear in society. But then when I look around and observe, like what you're seeing on paper, I'm observing the American consumer doing a 180 of what they're saying. And he's spot on.
Yeah, he is. So for whatever reason, yeah, I hope Americans get more happy here over the next couple of years because ever since COVID, it just seems like everyone's Debbie Downers these days.
Does, doesn't it? Well, the next thing is a reminder of volatility. So just to play into this theme, Mark, you hit it at the top of the podcast. We're starting off year to date. We are in this lower volatility environment. You are seeing not a lot of major headlines that are kind of moving the markets either way, and we're kind of seeing this slow grind higher. Well, there's a piece that Ryan Dietrich was talking about, friend of the podcast, on March 9th. And this is what he said, and I'm going to pull up a chart here in a second. His quote on this post is as follows. We are in the middle of one of the greatest 19-week rallies ever. Just remember, it usually isn't always this easy. And even in the best years, we have moments of fear and worry. We like to say, quote, volatility is the toll that we pay to invest. So I'm going to put this chart up, and this is going to be available in our show notes. And Mark, what this is a really good piece dating back to 1928 for the S&P 500 index that shows the historical likelihood of various sell-offs and how often they occur. And what you're going to see very quickly here, Mark, is that on average, in a given year, the market is going to have a 3% sell-off about 7 times throughout a calendar year. Okay. In that same type of example, going back to 1928, for a 5% correction during the year, that happens about roughly 3.5 times during a calendar year. So let's call it every 4 months, you're at least going to have a mild 5% correction. 10% correction you're going to see happens about once a year. A 15% correction about once every 2 years. And a 20% correction from peak to bottom statistically happens every 3.5 years. Again, why am I highlighting this? We're going through this period now of multiple consecutive months of really not feeling much of a correction. And I want to remind people, it's not a matter of if, it's a matter of when. We're going to go through some corrections most likely later this year. Is it going to be 3%? Is it going to be 5%? Is it going to be greater? Mark and I can't tell you that. But what we can tell you is that that sort of behavior is normal for the market. Mr.
Yeah,
McEvely, will turn it over to you for comments.
yeah, and I would just say that the longer we go without a 5, 10, or 15% correction, is that once it does come, it's going to feel worse than that because it hasn't happened in so long. And this is a common recurring theme, right? Happens every couple of years. Things are really good. Market sells off by 5%, and everyone's like, oh my gosh, what's going on? The world's ending. So it's going to feel rough because the past, several months since October, really, things have been rocking and rolling and doing pretty well. So, yeah, at some point, I would say this year, very, very high probability of getting some sort of sell off, like one of those that you just saw on the graphic. So that's not going to be a surprise. It'd be surprising if we didn't get one of those this year.
Yeah, and I think the only thing I want to add, I think you said it perfectly, Mark. I want to add to it that when that begins, that's when all the bull predictions come out of the woodwork, and all of a sudden you're going to hear, "Oh, this is the beginning of another 2022, 2008." Fill in the blank, and that could be the case, of course. But when you look at history, it's probably more of a short-term correction than an elongated bear market. So my next piece, and it all kind of plays together perfectly, is an update on active money managers, what their stock exposure is. So this is going to be a post by also Charlie Bolello, our friend from the podcast, on March 14th. I'm going to share this with you, Mark, and we'll kind of get some feedback. I got a sister chart to this I'm going to show you in a second. But what our listeners and viewers are going to glean from this chart is that from the average active manager back in beginning of November, when stocks weren't as favorable as they are today, the average stock exposure was only 25% of the average active manager's portfolio. You
Pretty
fast
low.
forward today. I'm sorry, say it again, Mark.
It's pretty low.
Very low, sir, right? In comparison to history.
And you can
Now,
see that corresponded pretty much essentially right with the market bottom.
and it absolutely did. And there's a couple observations you're going to get from this chart, and I can't wait to get your feedback. Now that the market has rallied since the beginning of November, the average equity exposure of an active manager is at 104%. Well, for those listening and they're wondering about the mathematics behind that, how can it be over 100? They are borrowing, they're utilizing leverage to get additional exposure. Guess what you're going to glean from this chart, though, Mark? At the beginning of the year, the stock exposure was also above 100%. And I'm sorry, what were the returns of the market year to date? All high single digits, correct?
Mm-hmm.
So I'm just throwing it out there. What is happening is I'm starting to see research pieces that the market is overextended and that we are going to see a prolonged downturn because of the rally we've seen the last 4 weeks. And people are referencing this index mark. Okay. So what I'd like to do is then show you a sister chart that I came across. This is going to be from Jay Capel. He is a senior market analyst at Sentiment Trader, and he posted this specific chart on March 16th. And what this chart shows you is any time the active manager index equity exposure was above this threshold and reaching 100% exposure, this is showing you the forward looking returns. Guess what you're going to find going back to 2008 when this occurred, Mark? Looking out 3, 6, and 12 months later, it's not bearish. So what you see on average is 2 months later, after the equity exposure goes above 100% and managers start utilizing leverage, 2 months later on average, the market's still higher by about 2% with a winning rate of 75% of the data sets. 3 months later, 4.2% on average higher, 79% of the time higher. 6 months later, 8.12%. The market's usually higher with an 89% winning probability. And 1 year later, 12 months later, 15.32% average, median return, 89% win rate. So again, I'm highlighting this because we're starting to see a lot of optimism out there, and people are thinking, okay, this has gone way too far too quick. And though we might be due for some sort of breather, consolidation, rest, use the appropriate term that fits your vocabulary. Longer term tends to not be a bearish sign.
Yeah, can you scroll back up to that first chart there? So if you're looking at this, it's interesting because the average active manager equity exposure in late December really reached over 100%, right?
Yes, sir.
So, and if you look what the market did, the market just kind of went sideways. So it doesn't mean that, once the average manager exposure gets over 100% equities, that there has to be a huge correction. It might just be a short little break, right? And that's what we saw from the end of December to very early January before the market continued higher. So if you used this as a sell signal in late December, you would have missed out on, the S&P 500's up a little over 9% so far this year. So not really a timing indicator, as most people, at least on the internet, say it is.
Well said. Now let's think about where we're at with the calendar. You were just talking about, hey, we're almost done with this quarter. You've had some strong stock performance in a lot of different indices. What could very likely occur is if we stay where we're at and the quarter ends, you could see the first couple trading days of Q2, you could see some initial selling pressure, just like you saw at the beginning of January, as bigger institutions are rebalancing. They are selling stocks, getting those back in line with their weights, buying other asset classes that maybe have underperformed during that time period. So it wouldn't surprise me if things ended exactly where they're at. The first couple trading days of the new quarter could be challenged by rebalancing, but then from there could continue, could evolve into a larger correction. We'll see.
Yeah. No, good piece there.
So it just highlights again for our listeners and viewers, it's going to happen. We're going to have some sell-offs coming later this year. Doesn't necessarily mean the beginning of a larger multi-quarter correction. Could,
right,
doesn't necessarily mean it.
right. Moving on to the financial planning topic of the week. This was an article written on FA Mag on March 11th that discussed the Biden administration's 2025 budget proposal if he were to get reelected. So this had a number of wide-ranging, in my opinion, financial planning impacts, I guess you could say, if this budget were to go through. What's the likelihood of that? Very low, but this is just the initial proposal. First step is he has to get reelected, and second step is the budget needs to get approved. So just something that's on the horizon. Some of these talking points have been in circulation for several years now and have not come to fruition. So again, none of this stuff has been implemented, but just wanted to put it on people's radar. So they start off by saying each year the president submits a budget proposal outlining their policy priorities in the year ahead. And in this case, it gives a preview of President Biden's priorities if he is reelected. The White House 2025 budget proposal includes a wide range of potential measures that could impact financial planning clients, particularly those with relatively high incomes. These proposals include increasing the top personal income tax rate to 39.6% from 37% on income above 400,000 for single filers and 450,000 for joint filers, and increasing the net investment income tax rate to 5% from 3.8% on income above 400,000. And the thing that I want to point out here, Matt, is that the top tax rate now, personal income tax rate, is 37%. And that's the tax rate if you make more than $609,000 as a single filer or $731,000 if you're married filing joint. This proposal is increasing that top rate from 37% to 39% on income that is significantly lower than what the top tax bracket is right now. So right now, the 32% tax bracket, you have to make just about 240,000 ish if you're single and 487,000 if you're married filing joint. So if you're in that 32% tax bracket now, you're going to be in that estimated 39.6% top tax bracket if this budget went through, because the income thresholds are significantly lower. So definitely would not be a benefit to high earning Americans. Another thing that could affect planning considerations is a proposal that would change the stepped up basis rule. So Matt, this is something over the past several years that has gotten a lot of airtime on TV. And this is when an individual dies, the basis of the assets that they owned is increased or stepped up to the value as of the date of death of the individual's death. So essentially, when a non-retirement account holder passes away, whoever inherits that money would have essentially $0 in tax liability if they were to sell everything, right? So, in my opinion, this is a huge benefit for beneficiaries because it's very common. We see it all the time, Matt, for older individuals or older couples to have six-figure unrealized gains in their accounts that they would have to pay tax on if they sold.
Correct.
So, the proposed change by the administration would treat unrealized gains as taxable income for the final year of the taxpayer's life, with an exemption of the first 5 million of unrealized gains per individual, and would have a carve out for family businesses. So I want to point out that this isn't only for investment accounts, Matt. This is for property, other assets that you might own. So this isn't
Farm.
just like stock and bond investments, right? Your car, yeah. So again, this would be non-friendly change to high earning Americans. Next is limiting the use of tax preferenced retirement vehicles by ultra wealthy individuals is also in the proposal, even though the specifics are unclear. I think the thing that they're trying to get at here, Matt, is remember a couple of years ago where there was an article that came out that somehow Peter Thiel,
Is
billionaire,
Roth.
had a Roth that had millions and millions, hundreds of
Billions.
millions of dollars
I
in
thought it was
it,
in the billions.
maybe billions.
Because he put founding shares of tech companies before they went public.
Correct. So I think that's what they're trying to get at there. So that's been talked about for a while. Nothing has come to it. And last but not least, the budget also calls for increasing the child tax credit to $3,600 for children under the age of 6 and to $3,000 for older children, which is up from $2,000 today. So
yeah, that thing's be a lot harder than that, Mark. His kids are expensive.
They are expensive. I'm just getting the first taste of that right now in the first 7 months of Mia's life. But so again, none of this stuff has passed. It's all just things that this administration potentially would want to implement. But we still have a long way to go before this is implemented. But most of that stuff would be things that people need to plan for if those changes do go into effect. So just wanted to bring that up, get that on people's radars.
Yeah, obviously when it comes to these types of topics, I am one for, lower taxes, obviously, just with what I do and my history. And, once the wealthier the person is, the more creative they're going to get about avoiding these things. And it ends up, the middle class, in my opinion, ends up carrying the water on these types of things. So that's my words of wisdom. Is that they really don't end up targeting the people you want them to target. That's my concern.
Right. Well, Matt, I think that's all we have for today. Anything else that you want to leave with listeners prior to wrapping up for the week?
Just two random comments, and this is why it's always nice to listen to the very end of the Independent Advisors podcast. First would be just know where we're at with the calendar. Mark alluded to at the top. We got earnings season's going to begin here in literally 3 weeks. The banks are going to kick off in the middle of April. You're going to have the majority of the S&P kick off in about roughly 5 weeks. That will dominate the market, dominate the narrative and the tape. I think the other area I'm going to be very curious to see as it goes over the next quarter and a half is breadth of the market and what's really moving. And are these mega caps going to continue showing leadership? Is the breadth going to widen and we're going to see more participation by small, mid, and the lower of the larges? That's stuff I'm going to be really curious about. I'll be talking about it on the podcast. But just know we're at with the calendar. We're almost done with this quarter.
Yeah. And not to mention, tax day is just under a month away. So
good to highlight that. Yep.
You need to get your tax documents in order and get those off to your accountant or doing it through TurboTax or a similar software. I believe that is April 15th or right around that date, Matt, this year. So thanks, everyone, for tuning in to episode number 244 of the Independent Advisors podcast. Hope you all have a great rest of the week, and we'll be back with you for episode number 245.
Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.